Hello, everyone. Welcome to week 12 of the Financial Wellness Boot Camp. Excited to be with you this evening. As you may remember, this is our gang here, Matt, Jordan, myself, and Yulia. My name is Bill Quinn. I'm your local financial professional. I share with everyone that, most of the high income earners, wealthy class, upper wealthy class in our country, of course, have financial professionals. They get a lot of information. They get all the information they could possibly want because they have the money to afford it. And that is the focus of most financial professionals is they want to take care of the wealthy people because it creates a better payday for them. But here at Wallio, we think differently. We honestly believe that the financial services and the education out there made available to the wealthy should be made available to everyone. And that's what we built this platform around. And we hope that this education and this information we're sharing with you guys is benefiting you long term. Like I said, we're in week 12. It's super exciting that for all of those who've made it all the way through the boot camp, it's a big deal. So let's take a look. Today is the last session. You made it. Some of the people dropped off. Not everyone's been doing their homework, which is not unusual, but the champions made it all the way to the end. You're going to be very successful. You're going to really appreciate all the things that we've put in place, and you're on a journey to having a great life. Your children, if you have any, will certainly appreciate your success later, because all these benefits will start to percolate and show up later on in your life as your lifestyle starts to increase and you start to enjoy life on a more confident and controlled basis. You will thank yourself for the tenacity of following through with this. You're in the right place. You're doing the right thing, not only for yourself, but for your family and anyone that you come in contact with. So, I've got $10,000. Where should I invest it? As we run this financial wellness boot camp, we see similar patterns all the time. A lot of people, particularly at the beginning of the boot camp, are asking the same question. The question is always, hey, I got a few $1,000s. Where should I invest? And I'm sure if we call this last lesson, where should you invest? A lot of people would skip the previous 11 lessons and would just come right to this one, hoping that maybe they become a millionaire overnight. This is honestly why we didn't call that last lesson, where should I invest? We wanted to make sure that the people that came here to learn financial wellness and the strategies that we offered got the best and the proper education. And everything was designed to be systematic, starting with creating a budget, understanding all the different characteristics that are leading up to the next lesson. And I think you're going to be very happy with the things we share with you this evening. If you've ever asked the same question, you should know that the answer to that question really depends on who you ask. So if I'm asking someone who performs, active money management, they're of course, a financial advisor. They're going to say, well, hey, bring your money to me. Let me invest it for you. Let me manage it for you. And of course, there'll probably be a fee along with that that you'll have to pay, because nobody works for free. What if you were to talk to an insurance agent? The answer might be an annuity. Hey, we've got the best annuities in the world. It's got the best interest. It's guaranteed from losing money. It only goes up, never goes down. It's honestly the best way to go. But why would an insurance agent would recommend an annuity? Because this is honestly what they're licensed to do. Insurance agents, do not have a license to recommend active money management and vice versa. So financial advisors don't do annuity recommendations and insurance guys don't do active money management. It's just basically what it comes down to. And while you're looking at this, you want to be looking at the cost for this advice and how that plays into your overall growth opportunities. So I've got the 10,000. Where do I invest? Real estate person is going to say real estate. Business owner is going to say, hey, invest in my business. Maybe your neighbor is going to say, hey, I've heard of this stock. Steer clear of that one. A lot of people are looking at cryptocurrencies out there now, like Bitcoin. There's a lot of financial apps on the market these days. I have seen a lot of them, and I certainly wouldn't take, investment advice from any of them. And your parents, let's face it, your parents are always going to be conservative when it comes to their children. They don't want their children taking chances or, And you know why, guys? They don't want you moving back home. They don't want to have to, once they get you out the door, they don't want you to lose everything you got going and end up moving back home. So I get it. I'm a parent. I know what they're talking about. And then grandpa, horses were profitable in my time, son. You know, old grandpa, maybe, 100 years ago, horses were profitable, but that's not today's situation. So if we were asked our buddy Ray Dalio, this gentleman is the one who always talks about diversification. Don't put all your money in one basket, all your eggs in one basket. By diversifying over different asset classes and different investments, you can secure those investments and help just balance out some of the risk. But he does say that over your lifetime, he can guarantee that one of those assets, and you probably won't be able to pick the right one, is going to have a disastrous situation happen during that time. Mr. Buffett, one of my favorite guys, his motto is never lose money. And I understand that. If you have an investment that it loses a certain percentage, often it takes double that percentage to get back to where you were before. So not losing money, that's a good philosophy, but is that reality? So I've got $10,000 to invest. My question to you is really, do you? This is how we answer this question. Remember, this is a financial wellness boot camp. We're not here to get with some kind of a get rich quick scheme or how to become a millionaire in 3 steps. So when someone tells me I've got X number of dollars to invest, I say, do you? I could have provided many answers to that question. Our team is fully licensed in all aspects of financial matters. But instead of answering, I challenge you, do you really have the money to invest? And why I'm saying that is, what situation are you in? Let's take a look at the situations first, and you'll see how it goes back over the boot camp and all the previous 11 lessons. Getting those things in place first is what you need to do before you even start to think about investing. In the financial wellness program, we want you to get certainty. We want you to eliminate the money stress, and we want you to live a better, fuller life. So, are you ready for the stress is the question, or the extra stress maybe. There are only a few truly safe, guaranteed investments, and such investments really pay close to nothing. So if you want better than nothing, you have to take on some risk. Risk usually goes with stress side by side. So before you decide where to invest your $10,000, ask yourself, is this going to cause me a lot of stress? Am I going to stress out about losing some of this money? Am I going to wake up every morning wanting to run to the phone to see what the markets are doing? And if I get some bad news, is it going to ruin my day? If losing money brings you stress, you're not ready to invest, guys. Statistically and scientifically, under stress, you will make the wrong decisions. So, what are your growth expectations? This is back to the rule of 72, which we've shared in previous lessons. Do you understand that this is a long game? Do you understand that even in the best case scenario, your 1-year gains, even in a well-performing asset, will not make a dent in your long-term goals, dreams, or aspirations? So what are your dreams and aspirations? Do you want to travel? Do you want to invest in your children's education? How about maybe getting a house, saving up for a down payment on a home, or padding your emergency fund? Or maybe, you're just seeking to get a very expensive lottery ticket. You need to be absolutely clear to yourself about what you're trying to achieve, to select the right risk factor to avoid disappointments in the process. So, are you in full control of your budget? Do you look like this young lady right here? I actually have a sister-in-law like this, and so it stands out to me. This is a basic financial discipline. If you're struggling with this basic financial discipline, you're going to be in trouble. Your day one, you're going to blow your budget. You're going to have to sell some of your investments at a loss just to get back where you started. And building your portfolio starts with building the discipline in your wallet. I often say, don't spend money you don't have to buy things you don't need to impress people you don't know. It's a recipe for disaster. You can see that we've talked about the weekly spendable here. That's your blue line down here. Any overspending, when it gets out of control, it just gets progressively worse. And then the next thing you know, you're having to pull money out of your portfolio to straighten out the disaster, because all of a sudden your credit card bills are eating up all of your money. It's just not a good way to go. So what about money leaks? If you're not leaking money, are you? Because if you are, the best investment is to fix the leaks. You can get an instant return for your $10,000. If you eliminate just $100 a month in money leaks, that's a 12% return on your $10,000, guaranteed. It's the best way to return anything you can get to the market, compared to the market. By leaking that $100 a month, you're giving away 2 years of living in Hawaii. And nobody wants to give away 2 years of living in Hawaii, I guarantee you. I've been there. It's an enjoyable place. If you get a chance to stay 1 year, you're going to want to stay 2. There's no two ways about it. So, bad debt. If you have some bad debt, have you been a little crazy with the credit cards? That can be a killer. Credit cards have a useful purpose. They help you take care of things, comfortably and systematically, but you need to be paying those things off every month. Otherwise, they can start eating away at your nest egg. You need to pay off your bad debt. Would be one of the best uses of this money, to get some of the stress out of your life, and you'll get the best return on investment by paying off that debt, because we all know that credit cards often carry fairly high annual percentage rates, and that can certainly start eating into your nest egg. Do you have a fully funded emergency fund? Do you have the big bag or the small bag? If you don't, then the first adversity will blow up all your investments. If the market goes down, you lose your job. Without a proper emergency fund, you're going to have to sell your investments at a loss. That's a killer. That's a killer for your investments almost instantly. If you don't have an emergency fund, this is going to be one of your best places to put some of that money and start growing that emergency fund. Take some of the stress out of your life and be prepared for situations that might arise. Is your income protected? Are you the one supporting the household? Are you the one that's taking care of the family and providing the income? Your kids rely on you. You may have some aging parents relying on you. Is the income that you're creating protected? What will happen to your investments if people, near and dear to you, lose that key source of income? Death, disability. Before investing in markets, invest in protecting your family, especially if you're the breadwinner and you're making sure that they have a roof over their head and food in their stomachs. How about your assets? You've accumulated some money. You've purchased a home. You have some things going on, and you want to make sure that you hold on to those things. Should anything happen to you, will your family be able to keep those investments that you've worked so hard to create? If no, what is the point of the investments then? You need to make sure your money, your assets, your equities, your belongings, everything you work so hard for is protected. Protected for you and protected for your family, so you never have to worry about losing it. Invest in the proper protection and make sure that you have it for this from this point forward. Will and a trust is a guarantee. If you own any kind of assets, if you have any children, you need to be getting a will and a trust. Are you contributing the maximum into your tax advantage plans? Here's 3 of them: 401k, IRA, and Roth IRA. Maybe you're getting an employer match. Are you taking full advantage of that? If you're not, this is where you want to invest. You're leaving money on the table if you don't. Before investing in any tax disadvantaged accounts, invest in the tax advantaged accounts first and make sure you're getting the full employer's perks. This will bring a better return on your investments. And then, is your family protected from you? Lastly, did you create any kind of a support plan to make sure you are not becoming a burden to your family at some point in the future? If your plan is to be supported by your children, then you better have invested into their education to make sure that they're going to get, they're going to be successful in life and they're going to have the income to be able to support you later in life. I know most people want to take care of their parents, but if that's the case, you love your parents, you want to be there for them when times get tough, then you really need to be making sure that you're financially sound, financially stable, and that you have the financial wherewithal to assist them later in life. So you're ready to invest when you check all the 10 previous steps that we just talked about. Lots of people try skipping these foundation, fundamental steps, And unfortunately, they fail. They fail at the first market downturn, at the first adversity, and then they end up right back at square one. So the pandemic happened earlier this year. Markets crashed. Whoever had $10,000 invested in the stock market woke up in the morning with only $6,000. People panicked. Unfortunately, they sold their stock. They sold their stocks at a loss, and then they turned around and they took the money and they stocked up on toilet paper of all things. That was some crazy months, guys. I just never did really quite understand that. But people who were ready did the exact opposite. They used the opportunity. They bought when the market was down and made a quick 30% on their money when the market started coming back. The market's always going to come back, guys. These are all businesses. Businesses are in business to make money. And in economic downturns, the people that have the money and have the strategy are the ones that are going to win. So all 10 steps are required. We do not recommend anyone play with risky investments until you get the fundamentals covered, or you at least have a solid understanding of each of them. Successful investors never take uncalculated risk with their money. So maybe you shouldn't either. That's so important. I'm going to say it again. Successful investors never take uncalculated risk with their money. So you shouldn't either. So what if there's a shortcut? There's a tool that plays into many of these categories, literally just one tool that allows you to sleep well, knowing that your money will never be lost in the markets, allowing you to save for a fully funded emergency fund. You can have it work, gross tax-free. You can have access to it without penalties. What if it provides your family with protection? What if it provides protection from predators and creditors out there that may be wanting to go after your wealth? What if it can be used as supplemental retirement income and even helps you maximize your retirement income later in life with all the tax advantages that go along with it? And as an extra perk, it protects your family from possibilities of humongous long-term care cost. Does it sound too good to be true? Where's the catch? Well, here's the statement. The tool does not solve all the problems in all the categories at 100%, but it solves a lot of them. For some families, just this one tool will be the best thing that they could do. Some other families may need to seek additional solutions. It really depends on each unique situation. So, life insurance retirement plan powered by Index Universal Life. We call it the IUL. How does it work? A quick reminder about how permanent life insurance work. Every month, your money goes into the insurance account, and it gets split into two parts. One part goes into the insurance, and the other part goes toward your cash value. The second part is yours. It's safely invested, protected from market losses, and this money grows tax-free within the insurance contract. So this big green block right here on this chart shows your cash and how it grows over time. The red block indicates an amount of life insurance you're buying from the insurance company. When you're young, of course, you need a lot more insurance because you have responsibilities and obligations. But as you become older, wealthier, and you have fewer responsibilities, you need less protection. And as cash value grows over time, the amount of insurance shrinks and becomes smaller. Permanent life insurance will pay no matter what. There is no term to it. It's continuous. This particular insurance policy was going to pay out $1 million sooner or later. $900,000 from the accumulated cash value and $100,000 from the insurance company in this particular scenario at, say, 85 years of age. But one critical thing to note was, what if this person lived longer? What if he didn't need the money? That money would continue to grow. It wouldn't stop just here at 900,000. It would continue to grow with all the tax advantages. There's no cap on this. As long as you have the time and the money and you understand the rule of 72 and exponential growth, this money will continue to grow. So the reason we call it Index Universal Life Insurance is because the growth of your cash inside is tied to an index. You select the index that you want to have it tied to. Most people know the S&P 500. It's one of the most commonly known out there. So when the S&P 500 goes up, your money grows with it. When the S&P 500 goes down, your money locks in and you don't lose anything. When the housing bubble happened, your money locked in, you didn't lose anything. But you got to ride it up. The recession happened, you locked in, you didn't lose anything. the recovery started happening again. Your money got to grow. The pandemic happened. You locked in. You didn't lose any money again. Every time when the market crashed and everyone's pulling their hair out, seeing their unprotected investments losing 20, 30, even 40%, you don't care. You're sleeping well. Your money goes up when the market's doing well, and then it locks in when the market goes down. You sleep well knowing that not losing money, you never have to worry. What was Warren Buffett's number one rule for money? Don't lose money. So, what about an emergency fund? What if during the recession you lost your job? Markets are down, unemployment rates are high, it's taking time to find a job, and you're running low on cash supporting your family and your living expenses. Well, in the index universal life insurance, you can get access to the cash when you need it. Just by simply making a phone call, you can get a check within a few days. No penalties, no withdrawal fees, nothing like that, like you might find in a 401k or other qualified plans. But it's even more sweet is you pay no taxes on that money. Your money grows tax-free inside the policy, and you get access to it tax-free as well. So you know what else you can do? You can use this thing for or outside of emergencies as opportunities. This is our buddy Sam over here. More money is made in down markets than in up markets. So when recessions come, everything is on sale. Sam could have used this money to buy some extra land when properties near him started losing value. Or maybe he purchased some equipment from a competitor of his when the guy had to go out of business because he hadn't planned properly. It does not have to be used for emergencies only. Emergency fund, check, but opportunity fund, check as well. Life insurance, honestly though, any life insurance should really be called death insurance. Life insurance is not insuring you from life. It is insuring your family from your untimely death. Death insurance does not sell well, so this is why we call it life insurance, right? Anyway, life insurance is a critical part of a financial plan, and an index universal life insurance does that extremely well. If you got into a car accident, the contract would pay $1 million to your family tax-free. If you got hit by a bus when you were 50, the contract would pay the $1 million to your family. If say you got had a cardiac arrest later on in life, your family would get $1 million tax-free. Wouldn't that give you some peace of mind of knowing that you did the right things and properly planning to take care of your family, just in case the unforeseen should happen? Remember, regular, term life insurance only pays till some particular age, and then it drops off. And I'm not saying term insurance is bad, but it has its purposes. But that's what we're talking about. We're talking about lifetime protection for your family, lifetime protection for your money, and a lot of perks that go along with utilizing a permanent life insurance contract. So even at a later age, if you're diagnosed with a terminal illness, the contract will pay $1 million to you right away, tax-free. You're probably not going to have enough time to spend it all, but you can certainly make some great memories with your family and your friends, and leave your family with some great memories of you even after your passing. Your cash is inside the IUL. It's invisible to predators and creditors in a majority of the states. This is huge because they're out there. These characters are out there. If you messed up somehow and you get yourself into a bankruptcy, in most states, you'll be able to keep your entire cash in this account. It's exempt from most assets. Most of these assets are exempt in most states. Similarly, if you get yourself into some kind of legal trouble, predators are coming after your assets, it's invisible. That's why they have the cloak over it. Full disclosure, it's not in all states, but honestly, it's in a majority of them. All other asset classes, cash, investments, real estate, everything you have will go through probate, and some court will decide who gets what, unless you have a will and a living trust. Your family will be stuck for quite some time sorting everything out. With life insurance, it goes directly to the beneficiaries and avoids probate. I'm not saying don't have a will and a trust. I think that's absolutely important, part of the key element. But with this one particular strategy, it bypasses probate and it goes to your heirs tax-free. You need it to protect other assets, and I'm just saying an IUL does it itself, and it has the will and the trust kind of built into it. So retirement income, you can spend the entire accumulated cash value in retirement if you choose to do so. You can get any amount of at any time, again, tax-free. There's no required minimum distributions like in 401ks and other qualified accounts. So if you do not want to take the money some years, you just let it grow. You just let it keep growing. And you can do that. If you want to take more money some years and go on a nice vacation, do whatever you want to do, that's your option as well. You can get as much as you need without increased tax bill. So this is great for supplementing retirement income, and that's another major check. Money accumulated within the IUL is safe. Okay, so this is maximizing tax savings here. We talked about investments, diversification last lesson. Diversification is similarly applicable to taxes. So if you have retirement savings in several buckets, you can use different buckets to pull money from and maximizing your tax savings. In a good year, like over here, you may decide to pull money from your non-taxable bucket and maybe the risky investments. On a bad year, you may decide to pull money from the taxable bucket, write off all the taxes and use the safe investments while you're waiting for the risky investments to make a comeback. There's no required minimum distributions. Non-taxable is safe. It gives you more options to maximize your retirement money. That's a major check. Even if you spend all your cash in retirement, insurance is going to pay off sooner or later. And it is a permanent life insurance contract. It always pays. However, it's not going to pay $1 million anymore if you burn through some of the cash. It's going to pay a smaller amount. In this example, $200,000 is passed on to the heirs from the insurance policy. It's there if you needed it for long-term care in the final years. If you didn't, it passes on to your heirs tax-free. That money could have been used for assisted living facilities, nursing homes, or whatever. But whatever's left over after your passing, like I said, passes on to your heirs tax-free and probate-free. Another long-term care, you got that covered. Another check. And last but not least, wealth transfer. You want to leave a legacy. We're all going to die at some point, guys. We just don't know when. The remaining cash portion in the insurance policy, let's say it's the $200,000, will be passed to your heirs, and they can throw an end of the life party in your honor and not have to worry about paying taxes on that money. If you're the kind of person who saves their entire life and wants to pass wealth on to your family, this is one place that you should think about putting your money. It grows tax-free. It's passed on to your heirs tax-free, and it avoids probate. Huge wealth transfer, huge check right here. It's not life insurance. It's insurance for life. Okay. Index universal life insurance is not life insurance. It's insurance for life. Number one, it protects your emergency fund from losses. Number two, it protects your family from loss of income. 3, protects your money from creditors and predators. 4, helps you build additional retirement income. 5, it helps you pay less in taxes in retirement. 6, pays for long-term care if you need it. If you don't, then it's there for other things. 7, and last but not least, it passes all remaining money to your heirs tax-free without probate. Index universal life insurance for life is insurance for life. If you can only afford one tool, one strategy, this is certainly the one I recommend for you. Okay. Swiss Army knife of finances is what we call this vehicle. Because of its versatility, we call the IUL a Swiss Army knife of finances. They're specialized tools that play in each of these particular categories, but not everyone can afford to own a specialized tool. Not every family can save 3 years worth of emergency fund, keep it safely invested to avoid inflation or losing sleep over it. Not every family can start investing early and maximize into retirement accounts and even afford a long-term care scenario. Maybe saving for children's education or a down payment on a house at the same time. Usually, families progress on this plan sequentially. They work in one area, then go on to the next, and then the next, one by one. While they're saving for an emergency fund, they're losing contributions to their retirement accounts, and they're losing the compounding interest. When they need to catch up on their retirement contributions, they cannot afford to be putting money towards long-term care. Index universal life insurance allows you to work all of these areas at the same time, not sequentially, but at the same time. That's pretty powerful. Once you have a foundation in place and you're ready to invest, options are very wide and require a whole different 12-week boot camp But having this one thing in place will certainly allow you to sleep better at night and knowing that you can have a safe and secure future. As we speak of index universal life insurance today, I'm going to show you two investment strategies you may only use with just the IUL. One is called the infinite banking concept, or be your own bank or family bank. And the other one is called Million Dollar Baby. So this is the one chart you want to be on the right side of, okay? You start off with pocket change, but you can end up with a huge amount of money. Infinite banking concept, as I said, is also known as be your own bank or your family bank. The concept allows you to grow your money exponentially. This is, once again, using the rule of 72 and exponential compound over time. You've seen this chart many times. This chart shows you the power of compounding interest. Money grows slow at the beginning, but then as it slowly starts to increase, and it really accelerates as you get near the end, having put the time and investment into making this grow to a really substantial amount of money. In this particular example, you can see the growth in the first 20 years is only $206,000, but in the next 20 years, it blossoms to $714,000. That's 3.5 times more money in the same period of time. We all want to be on the right side of this chart, guys. You want to be starting early, investing properly, and taking advantage of this. The infinite banking concept allows you to avoid paying interest to banks and to be on the right side. Let me show you how. So this is a chart where you're using debt to fund your purchases, and not a great plan. So let's kind of go through it. Most people, when they start, they have little or no savings. So they borrow money from the bank. The bank pays, money for, and then you use the bank's money to make large purchases, and then you have to pay that money back over time, and it's a slow process. Then you finally get it paid off, and of course you're paying interest along with that. And then, the red line shows borrowing. The dotted line shows repaying it back. Every time you borrow, you get into the negative and of course into debt. And every time you repay, you get zero interest. And, the bank's the one making the money. So by now you should know that this is probably the worst way to fund your lifestyle, because you pay both the cost of the thing that you're buying, plus you're paying interest for using the bank's money. So maybe there's a better way. What if you save first? In this particular scenario, you build up your savings in a bank account before making a big purchase. When you need to make that big purchase, you spend your own money from your bank account, and then you begin saving again for your next big purchase. You spend it again and you save it again. By retirement, you have all the same things you had in the previous scenario and a little bit of savings. This scenario is better than the first one because there's no loans involved. As a saver, you aren't paying the bank interest, so you keep getting the money and you don't have interest working against you. However, there's still a drawback. The bank is using your money as you're saving that money in the bank. The bank is using your money, and they're using your money to make more money. So what if you could do that for yourself? What if you could be doing what the bank's doing with your money, and instead of putting the money in the bankers' pockets and making the bankers rich, you could be doing this for yourself? This is how the be your own bank strategy works. So in this strategy, you save the initial investment, but instead of putting it into the bank, you put it into an insurance policy so it can begin earning compound interest. Remember that the IUL historically has averaged 7 to 9% and is never at risk of market losses. What's your bank paying you right now? Like 0.0 something? I think 7 to 9% is way better than 0.0 something. So like a bank, your money is safe in the insurance policy, but unlike a bank that basically, like I said, gives you zero, and at least in the IUL, you're earning much higher returns. And now that you're earning that interest instead of the bank, much better scenario. And remember that the longer your money is compounding, the more it grows over time. It is especially important in these later years when early on, 10,000 doubles to 20,000, but out over here, 200,000 doubles to 400,000 and 400 to 800. That's powerful. When you need the money for big purchases, instead of borrowing from the bank and paying the interest like in the first scenario, and instead of withdrawing and killing your account interest like in the second scenario, you take a loan from your policy. You're probably thinking now, well, wait a second. You said loans are bad. Well, when I've already saved, when I already have the money saved, does that doesn't make sense, right? Or aren't loans bad? Well, not so fast. Remember back in lesson two, um, we said in two scenarios, loans are okay. Two particular cases, and the cases are when they make you money or when they force you to save money. This loan fits into both those criteria. By borrowing the insurance company's money at a lower interest rate, usually between 0 and 4%, your money is still growing and earning more compounding interest than your loan is costing you. The insurance company will loan you their money because they hold something as collateral, and you don't have to pay back the loan because your death benefit will cover the debt. If you took out a loan and died without ever paying back the loan, they would just simply deduct the outstanding loan from your death benefit and then pay the rest of the money to your heirs. Insurance companies are at no risk on this loan, so it makes it easier to qualify for. You're not depleting your own money, like you did in the scenario number two, because you haven't touched the principal. That's all still in place while you're using the insurance company's money to make your purchases. But you should intend to pay the insurance company loans back to keep and keep making deposits over time to keep more of your money secured and growing for more future purchases. Every time you repay your loan, like you usually would, you are getting higher. It is like securing your spot in the line, walking out for your business and coming back exactly where you were, not losing your spot. Great way to go. A couple of important notes though. Insurance companies don't force you to apply for or for qualifying for a loan. You just need to make a loan request, and within 48 to 72 hours, your money's sent to you. Quick access to the money if you need it. Unlike a 401k, you have the restrictions that come along with the qualified accounts. This will give you cash in your pocket. Since the money comes from a loan, it isn't taxed. So unlike the 401k, you'll never pay taxes on the money. Unlike a loan against your 401k, you'll never have to pay the policy back if you don't want to. In fact, many financial educated people who use these policy loans to live off when they retire, and they never have to pay them back. So most people believe that insurance is only used after they die, but financially savvy people, like you're becoming here, working with Wallio and going through this boot camp, use their policies while they're still alive. That's why we call it life insurance retirement plan. So why is this baby so happy? Because he's $1 million baby, of course. By becoming your own bank, you can begin to use some of these other strategies. One of our favorites is our $1 million baby program. Imagine setting up your child or your grandchild on a lifelong path of financial wellness for the cost of a cup of coffee and a sandwich per day. When used for your kids, the be your own bank strategy creates even more powerful results than it does for adults. For starters, young children are very inexpensive to insure, so their policy values tend to grow faster. Their policies have a very long time to grow because they're younger, so compounding interest supercharges their cash value growth as they get older. Lastly, your kids tend to be more healthy than adults since they usually don't drink, smoke, or having years of lifestyle habits affecting their health like adults do. So life insurance companies see no need for health exams for small children. Maybe just a conversation with the child's doctor, and that means nearly every child will qualify for one of these. So let's look at a real world example and see how this strategy works. $1 million baby, a 1-year-old baby, maybe the parents or the grandparents buy an IUL policy for the baby at a cost of just $10 a day. The policy immediately provides $480,000 of death benefit, but that's not the primary purpose of the policy. The main use is for cash value, cash growth that will be guaranteed and protected from market losses. So as you can see, at age 18, the cash values have grown enough that the child now, a young adult, can take out $20,000 policy loan to maybe buy their first car if they wanted to. They can also leave it there and allow it to grow. At age 22, now a college graduate, they can use their cash value to pay off their college degree. Say it's $40,000. A secret strategy, though, and something we share with most people, is to, because these accounts aren't visible to qualifying for government assistance, use the student loans that you can get to pay off your college up front, which gives you 4 additional years of growth in your account. Then as the student graduates, they have a couple of options. They may have a loan forgiveness program if they qualify. If they don't, then they can go to their policy, use this money to pay off the debt, and then there's no interest on the debt itself. And you're saving all of those interest charges that go along with that. This strategy is only possible because the cash value life insurance policies don't count as assets or income against qualifying for FAFSA, which is the Federal Student Aid Program. Students whose families have traditional assets like bank accounts, 529 plans, Coverdales, can be disqualified from these FAFSA loans. So also note that both for 529 plans and Coverdales, all growth is taxed, and there's a 10% penalty if the funds aren't used properly. Something to be considered. A few years later, they turn 30. Your young adult now can use their policy to make a down payment on their first home. At age 45, the child becomes an adult. He or she can use their policy to maybe buy a second home, maybe a vacation home, or even an investment property if they want to. And finally, at age 67, he or she can comfortably retire. They make their very last payment. They pay nothing more into the policy in the next year. Instead, they can start taking out policy loans, and they never have to worry about paying it back. Assuming he or she lives until the age of 100, they can take over $100,000 in cash from the policy every year for the next 30 years. After they pass away around age 100, the insurance company subtracts the loans against the death benefit. In this scenario, is $360,000 that they had remaining in their policy, and that money is distributed to their heirs tax-free. That's powerful. The total money that was put into the life insurance policy was $241,200 over 67 years. Assuming no loans were taken before age 67, as reflected in this illustration, total funds taken from this policy equals $3.4 million, guys. Add in the $363,000 left as a legacy. That's $3.8 million. $241,000 in, $3.8 million tax-free comes out of this policy. That's powerful. Say, wow. People ask, where's the catch? Well, there is no catch. This is how compounding interest works. All the numbers on the screen were generated using very conservative 6.5% growth rate, where historically these have averaged between 7 and 9. We are using conservative illustration to be on the safe side and avoid overpromising. When you buy a policy for your child or your grandchild, you're helping them live a prosperous life, and you're leaving a positive, multi-generational financial legacy for their children too. Remember, Index Universal Life Insurance is not life insurance, guys. It's insurance for life. With the right attitude towards money and a good plan, you may live a very happy, balanced life and achieve financial wellness without ever investing or becoming ultra rich. Money is not everything. On the opposite, though, you can ruin your life by trying to invest into risky assets without having proper foundation in place. That's what this whole class is all about, guys, building that foundation and having that proper foundation in place. After that, it's all just making things better. Once you have the foundation in place, investment options are very wide and would require a whole different boot camp. Coco Chanel said, the best things in life are free. The second best things are very expensive. But I love this quote. It always reminds me that if I can't afford something, there is a better free alternative probably out there. I just need to look at the situation differently. I need to go out and enjoy more of the things kids are enjoying, doing the simple things in life, because it's the memories that you take with you. It's not the money. So remember, there's a lot of crazy ideas out there and where to save or invest your money. Now you know how to tell the bad ideas from the good ones. So invest in tennis balls. They have a high rate of return. Well, he obviously didn't listen to Mr. Dalio, or he'd be investing in some diversity and not just tennis balls, maybe footballs and basketballs. And if he's a really good diverse dog investor. He would even buy some cat toys, but we'll see. Now that you finish this course, you can be like Chuck Norris. Have your money work for you so you don't have to work so hard for it. This wraps up the Financial Wellness Boot Camp, guys, but your journey on your financial wellness path is just starting. Today is the first day of the rest of your life. This is a very profound statement. It's changed many lives and many people for the better. Think of us when you wake up tomorrow, and then think of it again the day after. How do you want the rest of your life to be? You spent 12 weeks building your financial plan, and you've completed 90% of it. Don't let it just sit there. Let's finish it up. Let's put it into action. You're in control. Like I said, today is the first day of the rest of your life.